Okay, so today's educational piece is on the call debit spread, which is an option structure, and we're just gonna keep it really basic. We're gonna cover some some of the ins and outs of a call debit spread, why you might choose a call debit spread compared to some other trades, and then um, we'll run through like the evolution of a trade like this. And let's go ahead and let's start. You may or may not, in your early option days, have spent a lot of time looking at these P&L graphs on the left side of your screen. You know, where it's like red where you're not going to make money, and it's green where you're gonna make money. It took me a long time to come to grips with these, but it's definitely worth the time investment to get familiar with them. And I'll refer to this type of graph using the Unusual Whales option profit calculator a few times later on in the slides. But essentially, what you've got with a call debit spread is a bullish structure. So your underlying view is that the stock in question, or the index, ETF, what have you, is going to move up. And as is the case in options, like 99% of the time, there are multiple names for the same thing. So you might see this referred to as a vertical call spread. You might hear it called a bull call spread. And a lot of times you might even just hear it called a call spread. And so whenever you hear call spread, my default assumption is it's a bought call spread. But as we go through these structures, you'll see that there are, you can sell a call spread, right? You can have a call credit spread, and let's start with some pros and cons. Pros: a call debit spread is lower cost than buying an outright call. A call debit spread has lower volatility than an outright call, and a call debit spread is easier to manage than an outright call. And I'll talk about, I'll like at least try and prove that those things are true a little bit later on. On the con side, right? Because in any structure there's going to be pros and cons. So on the con side, call debit spread has a limited max profit compared to an outright call, which theoretically does not have a max profit. The call debit spread has less impact from vega, and the call debit spread also has twice as many fees because it's two legs compared to one single leg, like an outright call. And I heard a really good quote from Ewan Sinclair that that transaction fees and commissions have an infinitely negative Sharpe. So you should take those pretty seriously, right? Like that's money you cannot get back no matter what. And so just at least being aware of your commissions and fees is something worth considering. And it is definitely worth considering that you have twice as many transaction costs to put a trade like this on compared to a single leg outright call. So how does a call debit spread work? Well, you have two legs, a long leg and a short leg. So you're buying one call that's closer to the money, and you're selling one call that's further out of the money than the long leg. And so on this screen right here, I took this snapshot this morning from JPM, so JP Morgan Chase Bank, and you could see the call debit spread that I'm talking about here is a structure where you would buy the 205 call and you would sell the 210 call. And at the time of this screenshot, which I'm sure changed throughout the day, the last traded price of the 205 call was $1.35. And the last traded price of the 210 call, the one that we be selling, is 50 cents. And when we go into this next slide, I'm going to refer to some of these other Greeks, but I know some of you might fact check me, but I promise I think I did a pretty good job of copy pasting those over. But when you build a structure like this, you wind up with a net position that is the combination of the long leg and the short leg. So As far as the payment goes, you paid $1.35 for the 205 call, and you received a 50-cent credit for the 210 call. So your net payment is 85 cents. You have a net delta that works the same exact way as the price to enter the trade. You have a net theta, again, exactly like the delta, and you have a net vega too. I don't think it's really that important to like actually do the math, but the important thing here is that you are your net long delta, and that's good because you want to make money if the stock price goes up. So you want to have positive delta on the structure. You have a negative theta, which means that as time goes on, um, if there's no change anywhere in the price of the underlying or the volatility of the underlying, then the value of this position will drift towards zero as time as time marches on, and you are net long vega. So if the implied volatility of JPM increases, then this structure will make you some more money, assuming everything else is held constant. So the big three, the ones you want to keep in mind on a call debit spread, are your net long delta, you are net long vega, which is good. You have a negative theta position, right? You're short theta. So if time goes by and nothing happens, you are going to lose money on a call debit spread. Okay, moving right along. What you can see here is the P&L diagram of a call debit spread. And I know you're searching around, you're looking on the internet, you see all kinds of these. The important thing to remember about this kind of P&L diagram is that it's showing you what the distribution of outcomes is at expiration. So if you buy, if you grab a call debit spread because you are bullish on JPM, and all of a sudden there you get some kind of event, some news breaks, and it's really and the market loves it. The JPM market is super excited, and all of a sudden now the market is repricing JPM like way up, and the price of JPM increases very, very quickly. You're not going to hit max profit on a call debit spread until expiration, right? You can see here I circled this. Days until expiration is all the way down at zero. You get this like, I don't know, like sideways kind of saw look, or like a knife, and then it's flat on both sides. You only get this at expiration. While the trade is happening, and hopefully my little recorded GIF works here. While the trade is happening, while time is elapsing, it starts off as this like kind of curvy, you have this sort of curvy thing, right? And as time goes on, that curvy P&L graph evolves into that like really sharp diagonal one. So you can see here, right, if you were to put that trade on and then 1 minute later like that, JPM just went straight to $210 from 190 whatever where it was at when I took all these screenshots and did all this stuff, then you're not going to be at maximum profit. You need to wait, or you need to let time elapse and move the P&L diagram into this final very brutal straight line version compared to this curvy version, which is actually going to happen as time elapses. I know that there are a lot of questions about this, so if we have some questions about the evolution of the P&L graph on these, I'm happy to field them. And more than anything, I know that it can be kind of hard to like translate the days to this type of visualization, this sort of graph. And so that's why I spend most of my time when I'm looking at a structure like this. I uh, I'm going to take the view and I'm going to switch it to what's called a table view. And then this table view lets me like kind of see, okay, great. If my view is that the JPM stock price is going to move up to $210, that shows me where where the outcome of this like what this structure is going to be worth at different times into the future. And I'm a big Excel enthusiast, so maybe that's why this like table view is so appealing to me. But it's just this sort of just makes it easier for me um, to grasp how this structure is going to change over time. And so you can access these graphs as well as this table view from the Unusual Whales option profit calculator. So we got an idea of what the P&L looks like. Now let's really lock in on what those outcomes are. So you remember this structure is you're buying a call that's like at the money to out of the money, maybe even a little in the money, depends on exactly, there's lots of different ways to pick your strikes. But what is unflinching is that the short leg must be further out of the money than the long leg. If you switch those two around, it's a different structure called a call credit spread. And we'll talk about that at some point in the future. But don't do that if you think the underlying is going to go up, because then if you're right, you're going to get hurt by that pretty bad. So, okay, you hit max profit when the underlying stock price gets above the short leg at expiration. So that's your ideal outcome. And your max profit is going to be the width of the spread. So like, in this case, we have a $5 wide spread. It's a 205, 210. So your maximum profit is going to be the width of the spread minus the debit you paid to enter this trade. So when I put this together this morning, this was marked at like 85 cents. So if it was a $5 wide structure and you paid 85 cents to get in there, then the maximum profit you can make on that is the difference of the two. So the maximum profit would be $4.15. At expiration, your max loss occurs when the underlying price is below the long leg. And in this case, it's very similar to just an outright call. If you buy a call and stock price doesn't go, if you buy an out of the money call or an at the money call and the stock price doesn't go up, right, it just kind of goes sideways or goes down a little bit or goes down a lot, then your call goes to zero, right? It goes to option heaven. And then finally, if the stock price at expiration is somewhere between the long leg and the short leg, then your calculated profit is just a little bit trickier. I don't want to spend too long on like exactly describing this, but in a nutshell, as long as the underlying price is above the sum of the debit you paid to get in and the long leg, you'll wind up being profitable. So in this example here, I said, okay, great. You buy this 205, 210 call debit spread, JPM price at like 5 minutes to expiration on Friday the 16th is trading at 206.50. Well, in that case, your profit is going to be 65 cents, because you'd be able to sell that spread for about $1.50. And the reason is because you bought the 205. The 210 has essentially gone to zero because it's out of the money. The 205 is in the money, and it's in the money by $1.50, which is something called intrinsic value. And I'm sure we'll do a lecture on intrinsic value versus extrinsic value. But as extrinsic value goes to zero on both of these contracts, you're left with only the intrinsic value of the 205, and that's going to be about $1.50 in this example. And so your profit winds up being 65 cents. So almost a double. Okay. So if you remember all the way back, yeah, up here, I gave you a list of some pros and a list of some cons, and shouldn't necessarily just take me at my word, right? Let's prove some of this stuff out, or at least let me let me try to convince you that everything I said here was true. So our first pro is that a call debit spread is lower cost than an outright call, and this one is pretty trivially easy, right? To buy a 205 call, you'd have had to pay $1.35. For this 205 210 call debit spread, you only paid 85 cents. So you paid a little bit more than half the price of the outright call. And the reason it's a little bit less expensive is because you're selling an option. You're selling an option, not just buying an option. You're selling an option against the one you're buying. Okay. I also asserted that these are lower volatility than buying a call outright. Now, I am of the belief that anybody who's ever bought a call outright understands the volatility on those, right? Like the price can change very, very quickly. If you could imagine where you're also short a further out of the money call, you can imagine that this dampens the price volatility. But it also dampens the implied volatility and vega impacts, and we're going to talk about that in another lecture, right? We'll talk about that in part 2, where we get a little bit more in depth on the volatility profile of a call debit spread, and why it is mathematically less volatile than buying an outright call. So I don't necessarily have the time to outright prove this one here, but my assumption is that for those who have bought calls before and have seen some pretty wild P&L fluctuations, you just kind of have an intuition that, oh, hey, if I sold a further out of the money call, then that would probably dampen both the lows and the highs.
And so one question that I got DM'd, actually, I don't know why homie didn't want to do it in the chat and give us that sweet, sweet engagement, but I'll still pass it along. Generally speaking, at what time would a call debit spread be the course of action? Is this something that people are playing around earnings? Is there something that people strategize and play in general whenever?
So I think it's potentially a good structure for lots of different scenarios. Earnings comes to mind right away because you so in the earnings scenario, and I'll try to really not go on like a real tangent about volatility, but in general, you have this implied volatility. You have a curve, and so as your calls go further and further out of the money, the implied volatility on that particular contract is going to get higher and higher. And as you go further in the money, the implied volatility on those is actually going to get higher and higher. But your vega, which is like delta, right? It's like your Greek that is impacted by changes in implied volatility. Your vega is highest at the money too, so it's in a lot of ways that's going to impact how your further out of the money calls are going to be priced. And so in the earnings situation, far out of the money calls tend to be kind of expensive, right? Anybody here who's speculated, gambled on buying far out of the money calls on an earnings announcement knows that those options they tend to be expensive, and they also know that the implied volatility on that contract is going to fall down really fast after earnings. So if you can sell an option like that, if you want to express an opinion that says, I think this stock is going to go up as a result of, after earnings. But it might not go up as, you don't exactly know, or you don't have a strong view on how much it's going to go up. Then selling a further out of the money call can be really advantageous, because not only does it make it less expensive to put this position on, but you're also selling like a high implied volatility option, which will have an overall benefit to the structure's P&L over time. Like it's a vega P&L will be better as implied volatility dwindles towards as it dwindles as time goes on. And I think, again, we'll talk about this in like the volatility version, part 2, but it's not uncommon to have something like a call debit spread, where you, like, when you put the trade on, both contracts were a lot more expensive, and the price has not moved in your direction as much as you necessarily thought it would. And as a result, that further out of the money contract price has fallen down quite drastically compared to your closer to the money contract. So both option prices have come down, but the further out of the money one comes down like a lot more. And that difference can be big enough to actually like kind of potentially let you out of that structure with a small profit, close to break even, small loss, as compared to buying one call outright and just having to take just taking a loss, right? There's nothing there to offset any of the vega decay that you're dealing with as that option approaches expiration.
Makes sense.
Yeah, absolutely. So again, don't have to get too far into it, right? But like when you look at the theta, like if you look at the theta profile of a call debit spread, there's like a really unique point here. As time, like this one that I built for this for our little example here today is pretty short dated, and so if you were to do like a longer dated one, then these red lines would be further out. They would be spread out a little bit more. But what you're describing is essentially the place where like the theta on this trade like kind of flips to becoming positive, which is also like another unique, nice to have thing about a call debit spread, right? I imagine most of the time, if you're just buying outright calls, theta is like never really working for you, right? It's like always working against you because it's always removing extrinsic value from your option contract. In a call debit spread, as price gets up to a certain point, your overall theta actually becomes positive. And that's pretty cool, because at that point you could say, yeah, if more time goes by, who cares, right? Like, let it go by. I'll make more money if price just stays put here. I don't need that continued accelerating price price increase, right? Once you get to a certain point, the theta is actually working. It's actually working for you. And the reason for that, again, without getting down to without getting too far down the road on the finer points of the Greeks, is that we know that theta, like magnitude wise, is largest at the money. And so when your long leg goes like in the money and starts getting further and further away from that at the money strike, and your short leg gets closer and closer to the at the money strike, the theta on the short leg, which remember you sold, so you're like collecting that theta, as that gets closer and closer to the at the money strike, you're benefiting from selling that theta, right? That like theta becomes large, and then as time goes by, you're like net collecting theta, because your long leg is so far in the money and your short leg is not quite, not quite as far in the money as your long leg, and so it's experiencing that theta decay at a larger magnitude than the deep in the money strike. Okay, so my next pro. A call debit spread is easier to manage than an outright call. So you're gonna have to bear with me on this one. When you buy an outright call and the trade moves in your favor, all of a sudden you have a bit of a predicament, right? Because you don't know, you have infinite upside, right? It could just keep going. Who knows, right? It could just keep ripping. If you had calls in the VIX yesterday, you might have held on to them for a long time because whatever instrument you're looking at, right? You have that wonderful uncapped maximum profit. And while that's great for your overall P&L, if you're really good at um, selling the exact top or knowing exactly when to exit out of something like that, uh, there are other mortals who maybe are not as good at like getting exactly out the right at the right time. And a call debit spread actually makes it kind of easy to manage because you like know once you get to it, once the profit, once the underlying price gets to a certain point, you've reached max profit. You don't have to like evaluate whether or not you think this trend is going to continue. You're done. You paid and you were right, and price moved a certain amount, and any additional moves are fine. That's great. You're already at max profit, and so you can theoretically you can do a really good job of planning your outcomes for a trade because you only have like three outcomes to consider, right? It's like I'm right and the price goes up a certain amount and it's over my short leg and I hit max profit, and that's great. I know exactly what my max profit is going to be minus transactions and what have you. And then you have the case where you're wrong and price of the underlying is beneath your long leg, and in that case, well, you lose. That structure goes to option heaven just like an outright call would. And then you've got that case where it's kind of in between the two strikes, and that's a little trickier. But compared to an outright call, there's less decision making that has to happen if you're right. And I think that there is a case for that being a pro. You know how much you're willing to risk, and you know what the payoff is going to be. And if you track your stats on something like that, then you'll be able to then you have some history, and you can probably start to you can not probably you can size these in a smart way. Maybe someday we'll do a really light review of something called the Kelly criteria. That we won't get too far into it, but there are ways to like optimize your sizing. And when you're taking a structure like this and you know what the maximum payoff can be, that helps you with some simplifying assumptions, and that can help you come up with like a plan that you can execute and not really need to second guess yourself about whether or not it's time to cut. Right? You don't have to. Once you get over that line, if you're right, forget about it. Right? Just let it go to max profit, close it. When don't necessarily let it expire, right? Because then you have to pay for the 2 exercise fees and all that stuff. But you don't have to. There's no overthinking whether or not it's time to get rid of this. So I think that was
Is there any case to be made for legging in and out of each leg of the spread? So say, oh snap, we're really ripping. We're already within my max profit range. I might as well cut the short leg and let the long leg fly. Is that something that
Like you could absolutely, right? Like why not, right? Like you can do that. You can, I mean, you could roll this thing up too if you wanted. If like you really underestimated the you really underestimated the move, then you could clip off this winner and slap another one on that's further out of the money. And in fact, if like price is really ripping like that, then this like volatility smile is going to get more steep, and the ones that you keep selling further up there will get like more expensive, and you might those trade structures might continue to be they might continue to be really beneficial. um, and absolutely you can leg out too, especially if you have some time. You can, like, if you slap this structure on and it turns out you're wrong in the beginning, um, then you can then that short leg is going to approach zero. And if your budgeted risk for this position is available, right? There's no, you don't go over what you set out for this trade in advance. But if you still have money in the tank and you like that long strike that you have, there's no reason you can't buy back the short. And then ideally, right, if you're Houdini, like then the stock price starts to go up again and your long call value starts to go up again, and then you can sell that call again, right? There's lots of things you can do, but you do have management flexibility, like you said. There's no reason that you can't close the short leg early, based on new information that's presented for your trade, for your structure.
good deal? We did notice, I think last week, I'll pull it up here in a second, there was a pretty successful call debit spread that opened on NVDA specifically.
Yeah.
And
Animal.
oh man, absolute animal. So I'll just give the quick spark notes here.
Yeah, sure.
So we initially saw this entry, like I mentioned, on the 115 and the 125 strikes on July 30th. And they took it at the bottom tick of that value, like I was saying. Here in the P&L of that call debit spread, you can see its value was never any lower than this. And then as the markets rallied into sort of the beginning of August, before we just started kind of pulling back again, of course, as everybody's noticed, yesterday going into today was a little different-ish, but you get what I mean. But here on their exit, which was merely a day later, I mean, they bottom ticked that perfectly when NVIDIA was trading at like 102.
Yeah, it was like right around $100.
Yeah,
I remember.
this person was an absolute Chad.
Yeah.
So
I think they got more size on than 34,000 too. Like as the day went on.
Yeah, I think you're right. As the day went on, I think when I wrote this article, I was trying to keep it easy on myself and go with the initial entry because, as you know, with spreads, getting that average price can get real wonky.
Yeah, totally.
But yeah, on one day later, the value of that spread was 428. They made about 9.1 milli on that trade.
Yeah, I mean look,
them.
when you're a deity, right? When you hold the crystal ball and you know NVIDIA is going to trade up 18% tomorrow or whatever. Obviously, you don't know this. I'm optimist. I know I've mentioned that before with you, buddy, but like I also don't necessarily think that there is anything nefarious going on here, right? I mean, there's something to be said for like a reflexive activity.
Yeah.
Like this guy putting this trade on this desk, put this trade on and did it in a very obvious way. There was nothing sneaky about it. Try to miss 90,000 bull call spreads in NVIDIA going off for like 3 weeks away too.
It's not like it was trickling in either. The initial size at 34,000 was single order, just boom, all of them.
Yeah. They were lifting the offer all day long on that, right? There was they're not doing anything secretive on a trade like that. And the difference in like, so there's an interesting difference between a at like an interactive market like the option market versus a betting market like popping open DraftKings and betting the over on the NBA. Like your bet on the over in the NBA doesn't influence the outcome of the game. But
Right.
if you're a size trader and other market participants can see what you're doing, your betting in the option market can affect, right? It has a reflexive type of impact on that. It can potentially have a reflexive impact on that market, and I can't help but think that seeing some seeing some desk put on size like that for an expiry 3 weeks away, um,
Caught an
maybe
eye or two, maybe.
had some people, yeah, right, caught some eyes, influenced some market participants to cover shorts, go long, what have you. That was a that was
Yeah,
pretty
they
impressive. Yeah.
a point that I didn't mention is that they ticked this the day before FOMC. And if you remember, FOMC kind of drove a pretty big bounce. Bears did not have a good time after FOMC, and I think a lot of people kind of expected instantaneous downside, and their expectations were absolutely demolished. But yeah, they ticked this perfectly. It bounced from like 102 in after hours on the 30th to 120 per share just the next morning. Just instant. It was crazy.
Yeah, wild. Very, very good. Very good one. And you know what we'll do? And again, I know I keep writing these checks for lectures that I will do. I'll do a presentation on some other ways you could have, potentially exploited exploited what was happening at that time using like a slightly different structure. You could use a time spread. To take advantage of what was happening at that time, because you don't put on size like that and not affect the pricing of those two options, right? So if some market participant is like just like smashing the bid down on the 125 call, because remember it's a bull call spread, so they're buying the 115 and they're selling the 125. The counterparty who is taking all that like short selling, that like the price on that is probably going to go down more than it otherwise would. So you can take advantage of that if you want to be a buyer there, and then you can try to structure something else that might pay off a little bit more than it otherwise would have, because you have this temporary dislocation from some animal who's putting down 85, 90,000 bull call spreads right there. So, okay, the con, limited max profit. There's a limit. If you on this trade, the maximum profit you could make is $4.15. If you just bought an outright call and JPM ripped, to $230 or $240, obviously, and you knew to hold on to that outright call, you'd be better off just buying the outright call, right? There is a limit on your on max profit here. There is less vega impact from those implied volatility changes. Again, I'm writing a check here. We will talk about the volatility impacts and why this is kind of like a skew trade. Okay, and then double the fees. I don't even need an image for this one. Like I said before, you got to pay for two contracts instead of one, right? And commissions and exchange fees and what have you are they're non-trivial. So that's just one of the downsides associated with a structure like this.
Trade-off you got to make for the protection, I'd say. It's like buying insurance, essentially.
Yeah, in a way, that is not a that's not a horrible way to look at it, right? You're damping down some of that volatility associated with an option contract. Okay, yeah, and then so when these slides are available to the world, you can look at, like, if you want to look at the Greeks, like as the Greeks change over time, why why does the delta on this actually go high and then go back low as it moves in your favor, and these sorts of, and that theta thing we talked about too. So, but that's it. That's what I prepared.
Somebody in the chat asked, maybe you mentioned this, but why not sell bull spreads instead of opening for a debit? So that would be, and I'll let Dan expound upon this because he is much better at explaining spreads than I am. There's no question about that. But if you're selling and doing a credit spread, that's kind of an inverse directionality that you're looking for. I would go as far as to say it's literally the opposite of a call debit spread. You're receiving a credit, so you want the value of that spread to drop rather than rise, so you can capitalize on that drop. And I'll let Dan take over that.
Yeah, that's a great question. You can express like a bullish trade by writing a put spread in the way that you're describing, and you can structure it to have a similar payoff. There are lots of things that you can do, and so one of the reasons, or something that is appealing to me, and again, I won't go like way into this for call debit spreads, is like the ability to take advantage of some skew, and I know that it gets tossed around a lot without a lot of helpful explanation. So let me go ahead and zoom in here, maybe 20. Okay, so this is on. You can as an Unusual Whales user, you can go and take a look at your volatility dashboard here. By going to an individual and then an individual security, and then selecting volatility from that dropdown. And then you go down over here and take a look at this, what's called the implied volatility smile. Sometimes you'll hear it called like the IV curve or the IV smile, IV smirk, something like that. And so, all right, so what's interesting here, I got to admit, I was like making my slides for part 2 today as well. And one of the reasons I picked 205 and 210 was because at the time, right, when I was making this, the 210 was like higher on this curve. The 210 was like somewhere closer to 28 vols. And the 205 was somewhere closer to like 26 and a half. And when you're selling a higher implied volatility and buying a lower implied volatility, then you are going to you're going to benefit from vega decay, right? It's not, theta isn't the only thing that decays over time. When you buy a really long dated like leaps call, for example, the vega on that contract is going to be very high. But as it approaches expiration, the vega is going to get smaller and smaller. There's just less time for a bigger move to happen, right? If you think about it in the time domain, and you're able to actually take advantage of this when you're structuring a trade. So this morning, when I was building my slides, and I picked these strikes very specifically because it was on this side of the curve. So now, all right, so let's think about what's happening to this structure. Again, I'm sorry, in the volatility one, I'll have like this stuff frozen in time, and we'll be able to see it more clearly. But at the time, the implied volatility of the 205 was the lowest one on this curve. And now that implied volatility has gone up by like a non-trivial amount, 1.5 vol points. Okay, let's just say it's gone up by 1 vol point. But let's think about that 210, right? That 210 was higher. It was almost 28. And now it's like 26.76. I don't know how clearly you can see it. But so like you sold a thing and its implied volatility went down, right? That's really good. The sale of that further out of the money call, as price was moving in your favor, the long leg where you have your where you have your like long vega, your long volatility exposure, that implied volatility went up and it got closer to the money. So its vega went up too. The 210 that you sold, its vega went up a little bit. Again, it got closer to the money, and that's vega is like a normal. It's not a normal curve, but it's highest at the money. But its implied volatility actually went down because it like slid down this. It slid down this curve right here. So you kind of won on a couple different fronts, right? You can act like you're a galaxy brain because the market moved in your favor today, and you sold higher implied volatility and it came down. So not only did you nailed it on that leg of the trade, and your like the leg that you bought had its implied volatility and vega go up. So you won on that side of the trade too. And that's above and beyond the delta win, which is, I mean, it's always going to be the biggest. So, you won on a couple different fronts with this call debit spread. So there are multiple, once you start creating structures like this, there are multiple avenues on which you can win. And that's a really good question. And so what happens, let's talk about a bull put spread really fast. I know, again, sorry.
And he actually brought that up too. And yeah, that is I would say a viable alternative depending on your goals. And as well, again, probably should have said this at the top, but this isn't something that you can do on a cash account to open these spreads unless you have copious amounts of money.
Yeah, unless you're doing it. Yeah, right.
This would require these spreads, most if not all spreads, I think, will require a margin account in order to open them. But yeah,
for the most part,
we'll definitely do a full primer on bull put spreads as well, for sure.
Yeah.
But if you want to hit a spark notes on it, feel free.
Yeah. Okay. So spark notes on the bull put spread. So that would mean you were selling. Maybe you're doing it like at the money, right? You're selling you're selling like 27.5 vol, and then you have to buy more expensive. You're buying this 30, you're buying almost 31 volatility points on that. Look, I mean, it's not going to matter if you're just directionally right on this trade, and JPM rips, who cares? The delta impact is going to swamp the volatility, the volatility impacts, especially on something that's short dated like this. But that's one of the subtle nuanced differences between a call debit spread when you're bullish and a bull put spread when you're bullish. The long leg on a bull put spread is going to be expensive. It might be more expensive than you want it to be. But a really good question. And I think those are an excellent way to express a long idea in the option market, because they're so forgiving too, right? Like, you'd be out of the money, price doesn't necessarily need to move in your direction, it can only drip down a little bit and you'll still be fine.
One more question, actually. Is one preferable for trading something like a 0 DTE SPY option? Depending on the price range it's trading in and kind of what you're thinking, I could see a use case for 0 DTE with a call.
Yeah, so especially, another great question. I want to jump all over this one, especially if you're willing to size up a little bit and trade SPX, or you're willing to kind of be patient and wait a little bit for a fill on XSP, which is like the 1/10 size SPX. Those are cash settled, and so you can make your bet and go do something else during the day, right? Like, because it's cash settled, you don't need to. If you just want to bet on SPX closing above 5,300 today, then you can slap on a 52.95, 5,300 call debit spread and pay. I don't know what it was going for this morning. Who knows? But if it was going for like 50 cents, that's like a 9. And you're right. That's like an 8 or 9x payoff on that, and you don't have to, like I said, you don't have to manage it, right? Unless, I mean, on the day of, on a 0 DTE, if you all of a sudden now, if your view has changed and you're afraid that the market is going to come back down, okay, well then maybe you do need to manage it. Maybe you do need to take your profit. But like, the beauty of these is that you can make a line in the sand style bet, and with SPX or XSP, because they are cash settled instruments, you don't even need to worry about closing them before expiration, because you just let them expire. They settle the cash. The next day, your account will be adjusted accordingly, according to whatever the SPX or XSP close price was. You don't have to worry about assignment, having to absorb $40,000 or $50,000 worth of SPY ETF into your account, the next day, and all that sort of stuff. There's something really nice to be said for cash settled instruments like SPX and XSP.
So it doesn't look like any new questions. I think we can put a ribbon on this bad boy. If you're not following Dan on Twitter already, I think he'll be doing a little bit more on the content side in the near future as well, as he's racking his brains with the data team. So give him a follow at Dan Wagner Co. That's also in the description. And I, of course, am Nicholas, the homie from all of the panels, etc. on Twitter at NicholasFNS. Thanks, everybody who came out and asked questions. And we'll do this again, same time, same place next Tuesday.
Thanks so much, y'all.
Take care, everybody.